Have you ever heard about people making money from their investments, even when they're not actively doing anything? You might wonder, how do they manage that? Well, the answer lies in something called dividend investing. It's a strategy that can help you grow your wealth and even generate a steady stream of passive income without selling any shares. Imagine this. You invest just $50 a week, and in a few decades, that small amount has grown into hundreds of thousands, maybe even millions, and it's paying you regular income in the form of dividends. Sounds like a dream, right? But it's possible, and I'm here to show you how. By the end of this video, you'll know exactly what dividend investing is, why it's such a powerful tool for building wealth, and how to get started, even if you're a beginner. So, what exactly is dividend investing? Let me break it down for you. When you invest in dividend-paying stocks, you're buying shares of companies that share a portion of their profits with their shareholders, people like you. These payouts are called dividends. Unlike growth stocks, where you're hoping for the stock price to rise so you can sell at a profit, dividend investing lets you earn a regular income just by holding the stock. That's right, you don't have to sell anything to get paid. For example, let's say you buy 100 company shares for $50 each, and that company pays you $2 per share in dividends every year. That means you'll earn $200 a year just for owning those shares. And here's the magic part. If you reinvest those dividends to buy more shares, you'll earn even more dividends next year. This creates a snowball effect that helps your money grow faster and faster over time. You might be wondering, why would companies want to give away their profits? Wouldn't they want to reinvest that money to grow even bigger? Good question. The answer lies in the type of company we're talking about. Most companies that pay dividends are what we call mature companies. These are businesses that are already well established and don't need to pour all their profits into expansion. Instead, they focus on rewarding their shareholders with steady, reliable payouts. Industries like utilities, consumer goods, and real estate are known for having dividend-paying companies. Think about it. These are sectors that tend to be stable and generate consistent profits, no matter what's happening in the economy. So, instead of using all their profits to grow, they share a portion of it with people who invest in their stock. Now, why does this matter to you? Well, when a company consistently pays dividends, it's sending a signal to investors. We're financially strong and confident in our future. This makes dividend-paying stocks more attractive to investors who are looking for a stable, less risky way to grow their money. Plus, here's another bonus. During market downturns, dividends can serve as a cushion. Even if the stock price drops temporarily, you're still getting paid, which makes these investments a little more reliable in rough times. Okay, so you've decided to invest in dividend-paying stocks. Now, how do those dividend payments actually work? Most companies pay dividends quarterly, meaning you'll receive your dividend payouts 4 times a year. Some companies pay monthly or annually, but quarterly is the most common. Now, here are some important dates you need to know about when it comes to dividends. Declaration date. This is when the company announces that it will be paying a dividend. Ex-dividend date. This is the key date. You need to own the stock before this date to be eligible for the next dividend payment. Record date. The company checks its records to see who the shareholders are as of this date. Payment date. Finally, this is the day when you'll receive your dividend, either as cash or reinvested into more shares. Here's the cool part. Many brokers offer a feature called Dividend Reinvestment Plans, or DRIPs, which automatically use your dividends to buy more shares. This is a great way to grow your investments without having to think about it. Now that you understand how dividends work, let's talk about a simple but powerful way to grow your wealth: reinvesting your dividends. Instead of spending your dividends, you can use them to buy more shares of the same stock. Owning more shares means you'll earn more dividends, creating a cycle that helps your money grow faster. This process is called compounding. For example, if you invest $10,000 in a stock that pays a 4% dividend, you'll earn $400 in the first year. If you reinvest that $400, your total investment increases to $10,400. Next year, you'll earn dividends on the larger amount, and over time, this keeps adding up. Now, imagine investing $200 a month and reinvesting your dividends. After several years, your portfolio could grow into hundreds of thousands of dollars or even more. The key is being consistent with reinvesting over time. The best part is that it can be automatic. Once you set up a dividend reinvestment plan, DRIP, with your brokerage, your dividends will automatically buy more shares, and your investment will keep growing without any extra effort from you. The earlier you start, the bigger the growth. You might be wondering, why focus on dividend investing when there are so many other ways to invest? Well, there are a few key reasons why dividend investing really stands out. First, let's talk about passive income. Dividend-paying stocks provide regular income without requiring you to sell any of your shares. This makes dividend investing a great strategy for building a reliable income stream especially for retirement. Imagine having a portfolio that pays you thousands of dollars in dividends each year. That's money you can use without touching your original investment. It's essentially getting paid to own the stock. Next is the power of compounding, which we touched on earlier. By reinvesting your dividends, you're setting up a growth cycle that gets stronger over time. This snowball effect makes dividend investing one of the most powerful long-term strategies for growing your wealth. The more consistent you are, the more exponential your results become. Dividend-paying companies are also usually more stable and less risky than high-growth stocks. These companies tend to be well-established and financially sound, having survived various economic ups and downs. While growth stocks might offer quick returns, dividend stocks offer both steady income and the chance for long-term capital appreciation, giving you the best of both worlds. Next good thing of protection dividends offer during tough market times. Even if the stock price dips, you'll still receive your dividend payments, which can act as a financial cushion. This can help you stay calm and avoid selling in a panic when the market takes a turn. Lastly, dividends can contribute to a more predictable investment strategy. While stock prices can be volatile, regular dividend payments offer consistency, which can be especially appealing if you're looking to create a more stable and predictable financial future. In short, dividend investing combines passive income, growth potential through compounding, stability, and a safety net during tough times, making it a standout strategy for long-term investors. Now that you understand the power of dividend investing, you might be asking, how do I find the best dividend stocks? Here's a comprehensive step-by-step guide to help you choose quality dividend-paying companies. First, check the dividend yield. The yield tells you what percentage of the stock's price is paid out as dividends each year. For example, if a stock costs $100 and pays a $5 annual dividend, the yield is 5%. While a higher yield might seem attractive, be cautious of extremely high yields, often above 10%, as they may indicate that the company is facing financial difficulties. For instance, if a company's stock price drops significantly due to poor earnings but continues to pay a high dividend, the yield may appear enticing, but could be unsustainable. Next, look at the company's dividend growth history. You want to find companies that have a consistent track record of increasing their dividends. A good example is Coca-Cola, KO, which has raised its dividend for over 60 consecutive years. This shows the company is committed to rewarding shareholders and has the financial strength to support its dividend payments over time. After that, analyze the payout ratio. This tells you what percentage of the company's earnings is paid out as dividends. A payout ratio below 60% is generally a good sign. For instance, Johnson & Johnson, J&J, has a payout ratio around 40%, indicating that it retains a significant portion of its earnings for growth while still providing a healthy dividend. On the other hand, AT&T has faced challenges with a high payout ratio of over 70%, which may make it difficult to maintain dividends if earnings decline. You should also evaluate the company's financial stability. Look for strong earnings, manageable debt levels, and positive cash flow. Procter & Gamble, PG, is a great example, with solid cash flow and low debt, allowing it to sustain and grow its dividend payments. You can find financial metrics through company earnings reports or financial news websites to assess a company's stability. It's also wise to diversify your dividend portfolio. Don't put all your money into one stock or sector. Instead, consider spreading your investments across different industries. For example, you might invest in utilities like Duke Energy, consumer goods like PepsiCo, and healthcare companies like AbbVie. Including international dividend stocks, such as Nestlé, can help reduce risk and increase your income potential. Another smart move is to look for dividend aristocrats, which are companies in the S&P 500 that have increased their dividends for 25 consecutive years or more. Examples include 3M and McDonald's MCD. These companies have shown their resilience through various economic conditions, making them reliable choices for dividend investors. Now, consider using dividend reinvestment plans, DRIPs, which automatically reinvest your dividends to buy more shares. This approach can accelerate your compounding growth without requiring any extra effort on your part. For example, if you invest in Realty Income Corporation, which pays monthly dividends, reinvesting those dividends can lead to significant growth over time. So, as we wrap this up, I hope you're feeling inspired to explore dividend investing further. It's a strategy that not only provides the potential for long-term wealth, but also gives you the opportunity to earn passive income along the way. By understanding how dividends work, avoiding common mistakes, and creating a diversified portfolio, you can set yourself on the path to financial security. Remember, the journey of investing is a marathon, not a sprint. Stay patient, stay informed, and keep reinvesting those dividends. A good starting point is to mix stocks from various sectors. For example, you might invest in utilities, healthcare, and consumer staples. These sectors often perform differently under various economic conditions. When one sector is thriving, another might lag, helping stabilize your overall returns. Let's take a closer look at why diversifying across sectors is important. The utilities sector tends to be more stable during economic downturns because people continue to pay their electricity and water bills, providing consistent dividends. Healthcare companies can offer growth potential as they innovate and develop new products. Lastly, consumer staples, companies that sell everyday goods like food and household products, tend to have steady demand regardless of the economy's state. Consider adding some international stocks to your portfolio as well. Investing in foreign companies can give you exposure to different markets and economic cycles. For instance, companies in emerging markets might grow faster than those in developed economies. This means that if the US market declines, your international investments could still perform well. Remember, diversification doesn't require owning 100 different stocks. A well-diversified portfolio can be achieved with 15 to 30 quality dividend stocks. Focus on companies with strong fundamentals, consistent dividend payments, and a history of growth. This approach helps spread your risk while positioning you for potential higher returns. Another effective strategy is to include dividend exchange-traded funds, ETFs, or mutual funds in your portfolio. These funds invest in a variety of dividend-paying stocks, providing instant diversification. They can be an excellent choice for beginner investors or those who prefer a hands-off approach. When choosing ETFs or mutual funds, look for those with a history of solid performance and low expense ratios. Funds that focus on dividend aristocrats, companies that have increased their dividends for 25 consecutive years or more, can be a great addition. This strategy helps you diversify while investing in companies known for stability and reliability. Now that we've talked about building a diversified portfolio, it's important to remember that your work isn't done once you've invested. Monitoring your portfolio is a critical part of successful dividend investing. Start by regularly reviewing your investments to ensure they align with your financial goals. Check if the companies you've invested in are still maintaining their dividends and whether their financial health has changed. Keep an eye on their earnings reports and any news that may impact their business. Be proactive about understanding how market conditions can affect your dividends. For example, during an economic downturn, some companies may reduce or suspend their dividends to conserve cash. Staying informed about these developments is crucial so you can make timely decisions about your investments. Consider setting up alerts for your stocks. Many brokerage platforms allow you to create alerts for price changes, news articles, and earnings reports. This way, you'll be informed about significant events without constantly checking your portfolio. Rebalancing your portfolio is another essential aspect of monitoring. Over time, certain stocks may grow faster than others, throwing your asset allocation out of balance. By rebalancing, you can sell some overperforming stocks and reinvest in those that may have underperformed or in new opportunities. This practice helps you maintain your desired risk level and keeps your portfolio aligned with your goals. Finally, regularly review the overall performance of your dividend investments. Calculate your total return, including both dividends received and capital gains. This will help you assess whether your strategy is working and if any adjustments are needed. Now that you know how to monitor your portfolio, let's discuss the power of reinvesting dividends, which can significantly accelerate your wealth-building journey. When you reinvest your dividends, you use the cash received from your investments to buy more shares of the same stock or fund instead of taking the cash. This is often done through a dividend reinvestment plan, DRIP, allowing you to purchase additional shares automatically without paying commission fees. Why is this important? Because of compounding. By reinvesting your dividends, you're buying more shares that generate even more dividends in the future. Over time, this compounding effect can lead to substantial growth in your investment. For example, if you invest $1,000 in a stock with a 4% annual yield and reinvest the dividends, your portfolio can grow significantly over 10 years. Be strategic about your reinvestment. Sometimes, it's smarter to take cash dividends and invest them in other opportunities, especially if you find undervalued stocks or higher-yielding investments. Balancing reinvesting with exploring new opportunities is essential. While dividend investing can be a lucrative strategy, it's important to be aware of common mistakes that could hinder your success. Here are some pitfalls to avoid. One of the biggest mistakes is chasing high dividend yields without considering the underlying fundamentals. Just because a stock has a high yield doesn't mean it's a good investment. A high yield can sometimes indicate that a company is struggling financially, leading to a potential dividend cut. Always analyze the company's financial health and dividend history before making decisions. Another common mistake is failing to diversify. Putting all your money into one stock or sector increases your risk significantly. Make sure to spread your investments across various sectors and companies to mitigate this risk. Pay attention to your investment time horizon as well. Dividend investing is generally a long-term strategy, and many investors panic during market downturns. Instead of selling off your dividend stocks at the first sign of trouble, remember that dividends can provide a cushion during tough times. Stay focused on your long-term goals and resist the urge to react impulsively. Don't overlook taxes. Dividend income can be taxed differently depending on whether it's classified as qualified or ordinary dividends. Be sure to factor in the tax implications of your investments to understand the net return you'll receive. By avoiding these common pitfalls, you'll be better positioned to succeed in your dividend investing journey. Focus on thorough research, maintaining a diversified portfolio, and sticking to your long-term plan.